Welcome to the show. In this episode, I want to cover advanced asset allocation using ETFs. Before I go into more detail, if you didn't watch my video yet on a simple asset allocation, please have a look first before proceeding with this video. I will put the link in the description. Overall, if we differentiate between different asset classes, there are three main areas. We have equity, fixed income, and commodities. If we go more details between these different asset classes, we can differentiate on equities, which are our stocks, between US market, developed market excluding US, which would be your Europe, Pacific, or developed countries, and emerging markets. On the fixed income side, we have government bonds, corporate bonds, and money market funds. From a commodity perspective, there's obviously many commodities, but from a pure long-term investment perspective, I'm only considering gold in this episode. So why we're deciding between different asset classes and allocating our funds in these different classes? Well, the main reason is that they have different correlations between each other. So if you look at the correlation between the S&P 500 and developed market funds, you can see there's a very high correlation. Then on the other hand, if we compare the S&P 500 to long-term bonds, we can see that they have a negative correlation, which means if the stock market is falling, long-term bonds are rising. And similarly, we can see, for example, a very low correlation between the S&P 500 and gold. So we want to take this to our advantage to hedge our portfolio and be able to balance it properly. So when we talk about asset allocation, we can talk about strategic and tactical allocation. So strategic allocation is that you set your assets a certain percentage. For example, you say you want to allocate 50% in stocks, 30% in bonds, 20% in gold, or whatever. And this allocation is set, and every quarter you rebalance, or annually you rebalance this allocation, but you don't change it. From a tactical allocation perspective, you will change the allocation based on certain events. So this could be macroeconomic events like GDP growth, employment numbers, consumer spending, or as well it could be technical reasons why you want to change certain allocations and move some of your money into different asset classes. In this video, I want to mainly focus on the technical aspects. So which are the different ETFs that you can use for this? From an equity perspective, we have always the S&P 500 ticker SPY, the Nasdaq, for small caps Russell, and for REITs the VNQ. On the international side, we have the Euro Stoxx 50, broad developed market ETF, Pacific ETF, and emerging market ETF. Then on a fixed income perspective, we have long-term treasuries, investment grade bonds, the total bond market, money market fund, and gold. These ETFs we looked at on this slide and the slide before, they have a part of the portfolio. But now how do you allocate them to your overall portfolio? So the main issue is that obviously nobody can predict the future. I don't have a crystal ball either. And in the end, we just need to use indicators that we have to kind of predict how likely a certain outcome is. So we look at the past performance and see how could this change the performance in the future. On the next few slides, I want to give you a few examples on how we could achieve this. So the first strategy is moving averages, which is around for quite some time. Basically, we look at a certain index and we look at the moving average. For example, here we can see the black line is the 200-day moving average and the 50-day moving average is the blue line. So we could, for example, develop a strategy where we say we stop investing in a certain index whenever the index is below the 200-day moving average, or another strategy would be whenever the 50-day moving average is crossing the 200, we would then stop investing. I will put in the description a website to a backtest so you can see how this worked in the past. On average, this works quite well, especially if you have a longer investment horizon. This is definitely a very easy solution to be implemented, and it works reasonably well and protects you from downside. So whenever this scenario occurs, you could then switch your allocation, and you can say, instead of investing in equity index, whenever we are below the 200-day moving average, I move my allocation from the equity index to a bond fund, for example. The second strategy is relatively similar and quite popular over the last years. It is looking at volatility, and especially the VIX index. So whenever the VIX index is over 20, 25, usually we have high volatility and usually a big downside. So you can see during the recessions, usually the VIX is trading above 40. And even now this is the case, right? With the corona pandemic, you can see, even so we had a significant bounce over the last few days, the VIX is still elevated and over 40. So a strategy could be that you hold your equity portfolio, but whenever we have a VIX over 20, 25, you move this allocation towards bonds, and especially government bonds, because during volatile times, usually as well, corporate bonds are under pressure and behaving similarly to stocks. The next strategy I want to show you is my favorite, and I think it's a quite good strategy that can be implemented as well relatively easily. It is looking at the relative strengths of certain ETFs. So the main idea is that you do back tests, and with the backtest you decide which one is the strongest ETF and most likely performing the best in the future. This, let's say, a momentum kind of strategy, and is looking at different look back periods and as well as volatility. I put here on the description as well a link to a website that offers free services for a small amount of ETFs, and they have a paid service for a large number. As a disclaimer, I'm not sponsored by them, or I'm not getting any compensation. But basically, yeah, what you can do is you can compare, for example, on this example that I have here on the screen, you can compare the US market against emerging markets, and as well, for example, a bond fund, and based on the strength of this ETF, you would then change your allocation. And you can see here on the screen, the strategy, for example, would have performed very well against a traditional 60-40 split. And the idea behind it is, well, if you have a larger portfolio, instead of just comparing, let's say, two equity ETFs, you want to rank them against each other. So if you have, let's say, 5-10 ETFs, you want to do the backtest and rank them to find out which one is the best ones, or let's say the 2 or 3 top ones that you want to allocate money to, and as well the percentage you want to allocate them to. Similarly, you would do the same, for example, for your hedge part of the portfolio. So you could compare, for example, gold against long-term treasuries and see which one has the best ratio and which one you should use this month to allocate your money to. And then the following months you would again rotate. So I think this is a very good strategy as well if you want to have some sort of active management of your portfolio. So have a look at this, and maybe do the back test and see how it goes.